Hi, good evening. Welcome to our weekly market outlook. Today is 9 June 2014. So if you can hear me, just give me a yes so we can start as usual. Very good. I saw lots of yeses coming. Okay, just a brief introduction of our today's webinar. We have four parts. The first part, we will talk about the recent fundamentals, like how's the jobs last Friday, how is the ECB conference, as I think that too probably will attract the investors most around the world last week. Even the payrolls data probably will even have the impact this week and the next week because we have the FOMC meeting next week. Investors are very keen to know that whether the Fed want to be appearing dovish or hawkish in the next FOMC meeting. So we will introduce to you what's our thoughts. And the second part, we will have the weekly events. So from the weekly events, we will let you know what kind of information you should look at for this week. So for the second week, compared with the first week of last week, like the last week, of course, the data is not so important, but still there's some data which is worth for us to take a look. And on number 3, we have the chart analysis. So we will bring the live charts to tell you where is the support and the resistance for the charts for the different currency pairs, and where's the trading opportunities, and what's likely the trend is going to for the different currency pairs. In the last part, we have the Q&A session. So in the Q&A sessions, if you have any questions, actually you can just type in the question box now. Just for all the questions, I guess we probably will have a lot of queries on the current financial market, because there's a lot of things probably will need to change, like the ECB's policy, like the Fed's policy. Probably there were some small changes or even very big changes moving forward in remaining of the year. So anyway, just start our today's webinar first. We are going to discuss about the U.S. economy, like its jobs and other like inflation, housing. Today, also we will tell you the what kind of ECB policy is going to impact the market moving forward. So the conclusion, not the conclusion, probably the leading idea is the U.S. and Eurozone economies landscape failed to bring down the euro. That's what happened last week. So what happened? So how about the future? Right, we still need to take a look. And we take a look on the last week's events first. You can see that we have quite a few quite important data from around the world last week, and lots of data even I haven't right inside because it's not so important compared with the one I listed here. First, let's look at the U.S. ISM manufacturing and the service index jumped from the previous month. So both of the index, which is one is the manufacturing index, the other is the service index in the US, are telling you that the recovery in the May are still extended from the cold winters in the beginning of the year. So momentum, besides the job market, everything is still being kept. Right. Second is the RBA. They kept the cash rate at 2.5% unchanged. Nothing too much about the RBA policy. Probably will be in the next quarter, probably in the third quarter. They probably will still tell you the same thing, unless the currency go too high or even too low, then probably they will adjust the policy a bit. But too low is not a problem, because we know the RBA prefer the lower Aussie. But if the currency is shooting too high, probably we will see some RBA to adjust some policy. But it's quite unlikely, given the high possibility that the US dollar probably will strengthen in the second half of the year. Although it's not very strong pace, but the pace is not enough to bring the Aussie lower. So number 3 is also very interesting. The Eurozone CPI dipped to 0.5% from previous 0.7% year on year. Once the inflation data announced, you can see that actually the euro goes higher last week, right? Lots of people are asking us that why the inflation last Wednesday coming out, but euro go higher. The reason is because lots of traders just close the positions after they see the euro dollar going down. So this is the typical sell the rumor and buy the facts. So the facts is they don't expect that there's a lot of things from the European central banks, or at least to the level that they're not very sure. So that's why they close the position first before the ECB conduct the policy meeting on Thursday. But this is reflect the problem that the Eurozone inflation now is really a problem, right? So even Mario Draghi announced some policy. We will introduce to you the details later, what kind of policy he says. But the market still seems like not by the story. The market thinks that probably the ECB needs to do more in order to help the Eurozone to return to the inflation environment. Australia GDP also topped the forecast, arriving at 1.1% quarter-on-quarter. This is also one of the facts that why the Aussie is outperformed last week. And one of the very important news for last week, I think it's the most important news of the week, is the ECB lower the interest rates. Not only lower the lending rate, they also lower the deposit rate and the lending margin rate. And they ending the S&P sterilization and inject a 400 billion euro TLTRO program. What's TLTRO is the target LTRO program. So how this program works is they will provide the loans to the banks. If the banks, let's say, lending to the public, let's say by 1 million, so they will lend to the banks. The ECB will lend to the banks according to the money they lend out, but that it doesn't including the mortgages. So that's a bit that's the only difference between this TLTRO and the Bank of England's FLS funding lending scheme, but the rest is all quite similar. But the market is questioning whether this is useful to in the Eurozone. Right? There's a lot of complicated conflicts, like very simple example, like the European central banks, the European banks are still very vulnerable to the bad loans. Now you ask the banks to aggressively lend to the public. Is that probably will bring the Eurozone financial crisis back if let's say there's an increasing bad loans? This is one concern. The other concern is ECB lower the deposit rates. So if the banks, let's say, they don't park the money with ECB, are they going to continue to buy more sovereign bonds, or are they going to lend to the public? So lots of things still not very clear at this moment. Right? So that's the reason you saw the euro is very have a very exciting trading day in the ECB press conference. You can see that initially the euro goes down after the ECB announcement, but just in a few hours, I think it's about 1 or 2 hours, euro just rebounds to the level before the ECB press conference. So that's the things we continue need to monitor. How is the market sentiment over the euro? And U.S. non-farm payrolls expand at 217,000, while the unemployment rate remains at 6.3%. Not too many surprises here, although the ADP numbers slightly disappointed to the market. It's below 200,000. It's about 179,000, if I'm not wrong. But the non-farm payroll still grow at quite a strong pace, and the unemployment rate still at 6.3%, no change. So just a quick two things here. When I look at the non-farm payroll, the first two things I would look at two things. One is the participating rate, but the participating rate is still quite low at this moment, meaning that lots of labor force, lots of people are still not returned to the labor force after the 5 years financial crisis. Number two is the wage growth. You can see the wage growth is still very weak. Month on month is only 0.2% increasement, and year on year is only 2.4% increasement. So the slow wage growth and the low participating rate are telling us that the structural problems, the underlying problems in the labor market are still unchanged. That probably will keep the Fed policy be stable, be accommodative for a while. And two pieces of news from China is exports rose to 7% year on year in May. That is definitely setting a very good signal that if the China exports go higher, because China is the world one of the largest exporters. So if the China exports increase, it means that the demand from the Europe and from the US is improving, because of the two countries are buying increasing products, are buying increasing consumer goods from China. This is one piece of news. It's a quite positive news. It means that the China's second quarter growth is likely to be stabilized after the first quarter GDP is slower to 7.4%. And the second piece of news is it's announced about 1 hour ago, is China central banks continue to lower some banks like the rural banks, or even some commercial banks, the triple R rate. So that is also encourage the banks to lend more to support to the economy, right? So we're not going to talk too many things about the China this week, because the focus is the Forex market focus, and the entire financial market focus is not in China. So, well, we just keep an eye, but not very focused on it. And what to watch this week? But you still need to watch the China data, like inflation, like loans, like industrial production. That's going to have some impact probably on the US dollar or on the Aussie dollar. And if you're trading Kiwi, it's a good news is this week the RBNZ, the cash rate, is back. So on Thursday they will vote for whether they will raise the interest rate to 3.25% or they will keep the rate unchanged at 3%. I think the chance is probably 60% they will not hike, and then 40% they will hike. And the reason is the RBNZ about 2 months ago mentioned that they are not very comfortable with the higher currency, because the Kiwi is quite outperformed compared with the rest of the currency because of the RBNZ policy. But if they want to do so, they probably, what they can do the most is just for this currency meeting, or for this policy meeting, they just can stop hiking the interest rate, just provide more volatility into the currency market of the Kiwi dollar. So this is the effective way to bring down the Kiwi, right? Because very important knowledge is, if one of the central banker, they want to they want to make their own currency higher, what can they do is they can reduce the volatilities, right? So, but if the currency, the central bank policymaker, they want the currency to be lower, like Kiwi, like Aussie, right? So what they can do is they can just increase the volatilities. Besides that, we have the Australia labor market report that will give you a further information that whether the Australian recovery is more on the traction, or it's just a very short-term recover, and moving forward probably still need the support from the RBA, right? We still need to see this the labor market report. And probably one of the most important news for this week is the US retail sales. That's the one of the last information before the FOMC meeting next week, right? So after the payrolls increased a lot, but the wage growth is still very slow. People want to know that whether there's any improvement in the U.S. Retail sales market, in the U.S. personal consumption market. All right, so this is the news which we need to focus for this week. As usual, we just have a macro summary first. I can see that things is very strange. It's not like what you think, right? At the first place, because why? The reason is, if you saw the report, like non-farm payroll increased about 217,000 jobs, probably the first reaction is the dollar must be outperformed last week, but no, it's not the case. So why dollar is not outperformed the US? The dollar is not outperformed. I think quite an important reason is because of the euro, right? You can see that like what I mentioned quite a few times this year, the dollar index actually is quite tracking with the euro dollar quite closely, not the rest of the currencies, right? You can see that the ECB press conference where Mario Draghi announced those when Mario Draghi announced those stimulus package, like this kind of an easing package, the dollar strengthening against the euro. On Thursday night, you can see the red chart below, right? So dollar shooting up, euro shooting down, but just in a few hours, it's about 1 to 2 hours. So when euro strengthening, so dollar just weakening. So that's why you can see the dollar is almost flat in the previous week, right? So you look at the chart. You look at the chart in the top, right? It tells you that the Aussie outperformed, Kiwi outperformed, Euro outperformed, Sterling outperformed, right? The only underperformed currencies is Japanese yen and the Canadian dollar. So most of the currencies still outperform the US dollar. Right, so this is telling us that the expectation on the FOMC next week, in about 10 days time, the expectation is still Janet Yellen will be excite some dovish option. We'll see some dovish stuff instead of hawkish. Right, so that's why the dollar will continue to stay at the soft side. They give us some clues. But you look at the Treasury market, right? What we say it's if you're a dollar yen trader, you have to watch the Treasury market, because if you don't look at the Treasury market, the dollar weakening, you probably would thought, oh, okay, maybe last week the dollar also weakened against the yen. But if you have that kind of mentality, you probably would be very wrong. You can see that in the beginning of the week, on 2nd of June, the dollar trading yen against the yen. The level is about 101.5. But when the Friday's close, the dollar yen trading at 102.4. Right? Why dollar weaken but dollar yen goes higher? Because we mentioned so many times this year is the best benchmark you can look at the dollar yen is look at the US Treasuries. Right? So US Treasuries have some slightly different view against the US dollar, right? Because you can see the US Treasury US start to going higher. Part of the reason I would say also because of the technical rebound, because in the previous few months or even weeks, you can see that the US Treasuries outperform a lot, especially the 10-year yield, right? The 10-year prices. So yield goes down. So now the market expect that the U.S. economy has start to recover, and there's some Fed members like the Fed member, I forgot which state he's from, but his name is George. She mentioned that it's a she, not he. She mentioned that the U.S. probably need to raise the interest rate as soon as the QE3 ends. And also the jobs data also and the ISM data also show the evidence that the U.S. economy is really improving. So that's a reason U.S. Treasury yield go higher, but still not very high, from 2.5% to 2.565, 2.5959%. So this is the reason dollar yen followed the U.S. Treasury to go higher. But you can see that there's some, you must be very careful about the divergency, right? You can see that the equities usually tracking with the euro dollar quite closely, right? Oh, sorry, the equity track with the dollar quite closely. But on last Friday, you can see that the equities still go higher because the data still supports that the economy is still in a very solid expansion. But the dollar goes lower. But the dollar goes lower, we just explain really mostly is because of the euro dollar going higher. So after the macro report, actually the market is still quite boring. Not too many things change, right? Currency market, the most theme is the dollar continue to stay in the weak side, although it's not so weak compared with beginning of the year, but it's still in the soft side. And the U.S. equities continue to go higher because the VIX, the volatility index, keep going lower. And for the Treasury, the yield start to recover a bit, but still very soft. So everything is very, I would say, it's very boring. Why? The reason is because the market is waiting for the Fed information next week. So anyway, before we look at the Fed policy, we need to get a clear picture of what happened in the U.S. non-farm payrolls. We need to look at some insights, right? So before we look at the insights, this is the broad pictures. You can see that the U.S. non-farm payroll is 217,000, right? So if you look at the entire trend of 2014, it's still a gradual pace going higher. In the beginning of the year, because of the cold weather, the labor market is not so solid regarding the hiring, the manpower. But after that, you can see the story slowly go higher. But in 2012, 2013, it's nearly all the flat, right? So now the trend is a slightly uptrend, but it's still not very clear that how does it go in the second half of the year. So you want the labor market to be so you want the non-farm payroll to form an uptrend. You need to have 250 or even 300 in later of the year regarding the non-farm payroll. But the unemployment rate actually goes all the way down, continue to going lower, right? From beginning of the year about 6.7%, 7% to now is 6.3%. The big drop is from the April unemployment rate. And the other exciting news you probably can read from the weekend newspaper, everyone is telling you that now the U.S. labor market, the non-farm payrolls, the total non-farm payrolls already exceed the pre-Leman crisis peak. So what does that mean is the total U.S. Labor market now, the total people who are in the labor force, it's about 138 million, right? That's already exceeding the 2008, the pre-Lehman Brothers financial crisis. So this is also telling you that just from the very surface view, the U.S. economy is still expanding, expanding in a very healthy way, right? So the charts here shows very clearly. And long-term unemployment rate dropped down, which you can see that the white color. So what is long-term unemployment rate? Long-term unemployment rate is those people who are not working for some certain period. So that is called long-term unemployment rate. Like they are not working for 2 years, they're not working for 3 years. So this group of people of the entire unemployment rate, in the entire unemployment population, the rates keep going down. Now it's going down to 34.6%, right? While you can see in 2010, the level is about 44%, right? But now the level is going down to 34.6%. This is another clue that the labor market is improving. But the only one thing makes us a bit confused is the participating rate. Why the rate is still at 6.28%, right? Participating rate means the people are still in the labor force. So if it's not improving, meaning to say that the people who are out of the labor force now has yet returned to the labor force. So if the economy improving, we should expect more people return to the labor market, but this thing is not happening yet. Right? It could be one issue is because there's some difference, the different view of the survey. So the other way to explain is the population. The entire population of the America is increasing. So this is the reason why increasing people get higher, but the total participating rate, the total labor force have not rebounded yet. So it could be one of the explanation. So just from the labor market itself, we don't need to look at the other growth factors. We don't look at the inflation sector. Just the growth, just the labor market growth itself, everything still looks quite healthy. So that supports the view that it gives the Feds the courage to show a little bit hawkish, maybe toward the end of the year. Of course, it might not be happen in the next meeting, the next FOMC meeting, but it probably will happen maybe in September, in October FOMC meeting. Okay, so when I look at these charts, it's very interesting. We need to look at what's the weak sector, what's the strong sector. But what attracts me is the weak sector. Which sector has the weakest expansion? It's very interesting. You can see that one is the computer and the electronics, but that's not big deal. The big deal you can see is the construction. Construction is only increased 6,000 jobs, right? You can see that the 6 month, the average is about 108, and 1 year compared with 1 year ago, that's 188. Compared with 2 years is 391. Compared with 3 years, that is 388. So, or 484. So, why the construction sector is so slow? It's very obvious, because the housing market is slow, right? The Federal Reserve, lots of things the Federal Reserve to do is the Fed wants a very robust housing market, but now too bad. I mean, see, in the past 6 or 9 months, the housing market is still very weak, and now see the situation is not changed. It's not changed yet, because if the situation change, you will see the construction employment go higher, right? So if not, the construction sectors, the hiring would be very slow. So this construction under the May non-farm payroll, it could be tell us that it could be a good reason for Fed continue to watch the payrolls data for another few months before they want to make them make the further move. The further move of course is not to raise the interest rate immediately. It's just to start to talk, start to discuss the exit strategy. But now I think it's still too early for them to do that, especially they saw the construction sector is still very slow, right? What if they're talking about the exit strategy, then the market is a bit oversensitive on that, and causing the treasury yield go higher, then followed by a higher mortgage rate, then the housing recovery will be even slower, right? So this is the case why we think the weak sectors, construction, probably still will make the Federal Reserve holding for a while first. So which also telling us that the next week, probably for dollar surge in the FOMC meeting, or after the FOMC meeting, the chance is slightly decreased. So FOMC insights is the Fed policy next week, right? So from now to the middle of next week, right? There's not too many very important data from US, right? So all the important data like non-farm payroll, like ISM, like ADP is all passed in the first week already. So now the focus now is the market start to a bit focus on the Fed policy again. You can see that from the technical point of view, we can see that the US 10-year yield Treasury, which is still in the low level of the current range, right? So that is give an indication that the Treasury yield since a year ago until now, for the past 12 months, the low range is about 2.5, the high range is about 3. So now the range is about 2.6059. So on the technical perspective of view, it tells you that in the later of the year, there's a higher chance that the Treasury yield will start to move higher, right? That is also consistent with the current fundamentals. Number one is the economy is improving. Number two is maybe from now to end of the year, there's a less reason for Fed to continue to be very dovish. So they probably will start to churn out some ideas that they probably will want to hike the interest rate somewhere next year. So Fed wants the low rate and the low volatilities for now. That is very clear, right? So there's two charts here. One chart is the volatility index, is VIX. You can see that the VIX is actually stay at 5-year low. It's a very low level. The other rate is 4.17. Guess what? Right, it's the US 30-year mortgage benchmark rate. So you can see that the VIX in the previous few years, like at least for the previous 3 years, it moved quite consistent with the mortgage rate. So if let's say the VIX is low, most likely the mortgage rate also stay low. Right, so Fed is very particular on this 4.17 mortgage rate, because in Fed point of view, although they cannot change the demand of the US housing market, but at least if let's say they put the rates low, there will be still some demand from for the U.S. For the U.S. houses. So if let's say the growth is still in the white cap, everything is still not very sure. So one of the preference the Federal Reserve holding now is they want the rates stay low. So that's why the VIX stay low. So everything for now is very clear. The Fed still wants this scenario to continue. Although we hear some people are talking about, okay, the Fed should hike the interest rate because the risk is a bit out of the control now. There's too many people looking for higher return of the investment, like equities, like high yield bond. So now the Fed need to discipline a bit. It makes sense, but the thing is, like what I said earlier, the growth is still unsure, still not sure, right? I have my point of view about how the Fed policy should go. Like, I mean, my personal humble view, but that's no point to share with you because I didn't represent the Fed, right? So in the end of the day, we have to know what Feds think, right? So if we know how the Fed think and how the Fed should conduct the monetary policy, then probably it will have a higher chance for you to have a to gain some to have some gains in the currency trading market. So housing is a concern for Fed, but can the Fed really help, right? It might not. But at least I would say now the U.S. pending home sales still go down. You can see, which is the white chart, right? So this is on a year-on-year basis. You can see that the pending home sales. I like pending home sales instead of existing home sales because the pending home sales is the perspective for the coming a few months, 2 or 3 month time, right? So, but existing home sales is only tell you the current month, but it cannot tell you the next month. So anyway, you can see the pending home sales actually is going lower and lower, but the housing supply, which is the white color of the line, you can see the housing supply actually is going higher. So at this moment, you can see that there's more homeowners are willing to sell their house, and if the demand can be picking up from the supply increase, if the demand can be also increased a bit, then probably there's some recovery of the housing market. Since you can see that in 2013 in June there's a recovery, but after that it's fading. But okay, before the middle of June last year, you can see like there is some recovery, but after that it's just falling. So now in the environment that the supply is increasing, I would see the Fed would be very cautious, right? So still, I would see demand is the key, right? You can see that when I look at the U.S. Housing sales, right? You can see that it's the white color. The other is the yellow color is the mortgage rate, right? So my point is, in the end of the day, policy rate is just policy rate, right? So the most important is the demand. You look at 2007, 2008, the time the rates, how much is about 6%, right? 6.5%, but the housing sales is much higher than the current level, right? So the argue point is the Fed has to admit that there's lots of things beyond the monetary policy which they cannot help. In the other words, monetary policy cannot help. It's no way to solve all the economy problem. Lots of things still will need the fundamental to decide which price to stay at, which price to stay there. And the US always trying to promote the capitalism, right? So one of the very important definition for the capitalism is the central bank should have a very should not quite often to influence the prices. It should let the market to decide the price by itself, right? That is also increase the efficiency and the effectiveness of the assets allocation, right? So demand is still the key. ECB, what's wrong? If you look at the euro last Thursday, right after the ECB press conference, I believe that most of you probably already noticed that lots of things is very weird. So why euro goes down first, right? About 100 basis point, then immediately shooting up 120, 130 basis point in the just like nothing changed. And the ECB seems to do lots of things already. You can see that on Wednesday, last Thursday, right? The price initially is the high is about 1.36, 1.361. Then after the ECB announced the policy they want to do, then about 12 p.m. it goes to 12 a.m. it goes to 1.3540. Right? But after that, it just all the way back, just in about 1 or 2 hours. So what's wrong with that? Still, I would say not so bad for Mario Draghi if you look at the entire month, because when the May 15, the euro going all the way to 1.4, right? The price compared with now after 2 months, after 2 months. So the rate is still 1 month. The rate is still at 1.3651. It's still much lower than 1.4, right? So the rate compared with the peak period still lower about 350 basis point. So for Mario Draghi, because he is not a day-to-day trader, right? Of course, he needs to monitor the euro prices, but he is not a day trader. So at this kind of a result, I would say Mario Draghi should also quite satisfied. So what Mario Draghi did in last Thursday, here's the details in case you miss it. It's all historical move, right? He is the major central banks, number one, to cut the deposit rate to minus 0.1%, right? SMB, Swiss central banks did that before, and Sweden central banks, I think, also, or Denmark central bank also did that before, but that is a small economy, right? But I'm talking about the major central bank, that the first one who make the deposit rate at minus 0.1%. So what does that mean? It means that if you are a bank, you want to park, let's say 100,000 or 100 million with the ECB, you need to pay ECB the money for park your money. So it's quite ridiculous, right? It's like you put your money with the bank and you need to pay the service fee for the bank. So it's not like you get a loan from the bank, then you pay the interest. Like you deposit the money to the bank, you still need to pay the interest. So what's the idea? The idea is, the ECB original idea is they encourage you to to put the money in the riskier place, right? It's even buy the sovereign debts, or even buy some other assets, or even lending to the public, right? So that's the idea. Number two is it's open a 400 billion liquidity channel tied to banks lending, and official will start work on the asset purchase plan, right? So what does this mean? I just explained earlier is, if you lend to the public, you lend to the SME, let's say by 400 million, so ECB will give you the cheap funding for this amount, right? So based on the size, you lend to the public, right? Also, they ending the sterilizations of the S&P bond purchase, right? This is what does this mean? This means last time, if ECB purchased the sovereign bonds, let's say by 200 million, so they will put the 200 million back to the money system. So make sure that the money they spend, there's a cash, the same liquidity is there. But now they're not going to put the cash inside. So they're going to increase the liquidity into the market. So the question is, why not enough? Because the reason is the deposit rate cut, then what, right? The banks lend to the public, it's quite unlikely, because we know that lots of banks in the Europe, especially the peripheral countries, they're still not very willing to lend the money to the SME, right? Because the reason is the risk is too high, right? The bad loans in the European banks still has a lot. If let's say they increasing the lending, it's actually increase the risk for the banks. So of course on the bank side, they are also not happy. It's like if you don't want to help the economy by yourself, you don't want to buy the bonds by yourself, why you should ask us to purchase to help you, right? So number one. Number two is TLTR. Is that a practical move? Right? Like lots of we mentioned that the loan demand in the eurozone is also very low. Lots of SME, they don't need the loan at this moment, right? The reason is the economy is still very slow. I mean, compared with 5 years ago, 10 years ago. So this probably will they had some overcapacity in the economy already, and the unemployment rate is so high. So the company doesn't want. It shows that the company doesn't want to expand. So if the company doesn't want to expand, what point they want to get some lending from the bank? So this is a reason. The initiative of the ECB is to increase the loan size, but in the end of the day, it might not help. Right? It might not help. Right? The reason is because some channel is broken. Right? Okay. So the second piece of news is let's assume that it works. And then is that possible that it will harm the economy, or do you think that? And do you remember the debt crisis, which is not far ago, right? So lots of things it happens. It did not go to its objective. For example, let's say I am a bank in Europe. I'm an ABC bank. So I need to get a loans from the public. I need to get a loan from ECB. What I need to do is the first steps, I need to lend out a lot of first, right? Because if I lend out more, so I can borrow more from the central banks. So the business margin is better for me. But the risk is, would they conduct a very good due diligence check? Like this company, the credit risk is quite high, I should not lend to you. And that company, the credit risk is low, I can lend to you. Probably this part will be missing. If this part is missing, then the debt crisis might come back again, because the recovery of the euro zone is still very weak. The other I want to talk is the China data. This is a very quick one. Continued support for stable Aussie. Right, there's a no selling off of the Aussie pressure at this moment. The reason is we just see that recently the China official continue to use lots of pro-growth strategy, to support the economy. So this is one of the reason why the Aussie is also so stable now. So for this week, you will see that the Chinese economy probably will continue expanding in a very solid pace in the month of May. So that's going to support the Aussie as well, right? So today, on the fundamental side, we just covered the U.S. jobs, and we covered the Eurozone, the monetary policy for a while, right? So let you have a very brief, or at least slightly more clear understanding of what happened last week for the two big events. So now let's go to the poll time. The poll today is a big link to the FOMC meeting next week. Is when do you expect that the Fed should raise the interest rate? Right, you can choose end of this year, and you can choose before the middle of next year, and you can choose after the middle of next year, but still in mid next year. In the last choice, the last one you can choose 2016. Looks like most of people still expect they will raise the rate in 2015. Number 8 is 18% choose end of this year, right? If the economy, if it happens on A, the economy must expand very, very quickly and very, very fast because the QE is even end of probably end of this year, right? So another 43% choose before middle of next year, 33% choose after middle of next year, and 3% choose 2016. My opinion, I would choose probably B or C. It's very hard to say from now. So let's see what's the FOMC meeting next week. You know, so that probably will give us some clues, right? So let's close the poll and go to the this week's events. This week's events, you can see that Sunday the China trade balance increased a lot, and tomorrow 12 a.m., which is, am I seeing the right time? Oh yeah, 12 a.m., which is the time is very weird. It's about the Australia like 4 a.m., right? The Governor Stevens will speak, so don't know what he's talking about. So anyway, let's see whether tomorrow morning got any the substantial Aussie move, but the time is very weird that he speak at 4 a.m. So, well, and Tuesday tomorrow we also have the China CPI, right? Also afternoon we have the manufacturing data in UK, and on Wednesday we have the Australia consumer sentiment, and nothing not very important, and the unemployment rate in UK. All right, let's see whether the UK the unemployment rate continue to drop below 6.8%, but it's very hard to predict the move of sterling, right? Because we noticed that last month when UK announced the unemployment rate goes down from 6.9 to 6.8%, but the sterling goes lower, not go higher, right? By right, if the rates go lower, so it means the UK, the BOE, the Bank of England, they will withdraw the stimulus probably slightly earlier, but so sterling should go higher, but we see that sterling go lower, so a lot of things is still very weird, right? So that's why I seldom use the fundamental to explain UK, the sterling, because the move is very bizarre. Thursday, you have very interesting morning, because on 5 a.m. Asia time, we will have the RBNZ cash rate, right? So the market expectation is they will hike the rate by another 25 basis point. The previous is 3%, but I think probably this round they will probably if they put the currency on hold, they putting the interest rate on hold, do not hike the interest rate, probably the Kiwi will lower. But if they continue to hike the interest rate, then the Kiwi will move to another high, and it's really like telling you that the inflation in New Zealand at this moment is one of the bank's biggest problems, right? It's even more important than the inflation, more important than the currency, right? So I think probably they were on hold, but anyway, the forecast is 3.25%, 25 basis point hike by the Forex factory. And 9:30 a.m. we have the Australia labor report, and at night we have the U.S. retail sales. The retail sales shows that it should have some improvement because the labor market improved. And on Friday, nothing too many important. We have the Japan monetary policy statement, most likely it's the same. In China, we have the industrial production, right? And night, we have the US PPI. So that's all for this week. The data, you can see that on Thursday, we have some meaningful data, but the rest of the days, the data is not so important. So now let's go to the, before we go to the charts, still there's an introduction for everyone that we have the weekly and the daily reports in our FX new website. It's the Fxprimus website /education, and besides that you have a live account, so the minimum funding is about $100 US. And recently, we also have the gold future trading platform, so it gives you a lower spread, right? So the gold future, you can also take a look, especially we know the the gold prices is very linked to the current linked to the FOMC meetings, the Fed policy. So if you are very good at, let's say, guessing the Fed policy, it's a one very good market for it now is the gold market, right? Because the US dollar, it might not track the Fed policy very sensitively, but the gold still will. All right, so now let's go to the live charts. The first currency pair I'm looking at is the euro dollar. The euro dollar, if you look at the hourly chart, right, from the fundamental perspective, I have an argument for the market behavior last Thursday, right? Okay, you question the ECB that the market questioned the ECB that whether they can reach the 2% inflation, right? So that's why the euro goes higher. But this euro go higher is more like I would say it's more like a punishment. It's not. It's more like a challenge, not a punishment, but it's more like a challenge, right? But my argument is, if the euro fundamental is weak, if the euro inflation is low, or the recovery is very slow, did that deserve a higher euro? It shouldn't be, right? A weak economy should be deserve a weak currency, not a strong currency. So I would say the market behaved last Thursday is a bit emotional move. It's a very emotional move. So the strategy on trading euro, I think, is still sell at the peak. So if there's any major rally of the euro, it should have a good time for it to. You should always looking at to sell it. So what is the level to sell it? I have a two level here. One level is you can looking at to sell at this level. This level is quite a lot of a major resistance based on the hourly chart with 1.3645. This is the level you can looking at to sell. The other level you can looking at to sell is the recent hourly chart, the double peak, which is the double top, is at 1.3670. So definitely, I'm not looking at to buy euro at some certain level, right? The level is for me to take profit if I want to buy euro. So two levels I'm looking at to sell. One is 1.3645, the other is 1.3670. Like why I say it's the combining with the ECB policy. And do you think the Mario Draghi will allow the euro to go higher and higher? That's a bit impossible. Like he is like watching the inflation so closely. So a higher euro definitely is not helping the country's inflation. So when to take a profit, right? So you can looking at 1.3585, right? So before Mario Draghi give another information, I probably would look at I will take profit at this level because there's no point to holding it further for a while because there's no very important euro data, but the possibility is whether the FOMC meeting next week will give any surprise to the US dollar. So if you're shorting euro, you should expect the euro to go weaker against the dollar. The dollar will go strong, but we don't expect that happen. I mean, the dollar could be strengthening a bit, but it's quite unlikely the dollar will strengthening a lot. The reason is we don't expect the Janet Yellen to announce lots of hawkish comments. So our take on the currency pair is still look at to short for this currency pair, but we are not like taking the profit like 100 basis point away, 150 basis point away. The price has a chance to reach 1.3585, probably will take profit. The second pair is dollar yen. Dollar yen, we mentioned that the trend is slightly going to upward, right? So there's no selling off in the past few weeks. And we are, so in the past about 2 weeks or 1.5 weeks, it looks like the dollar yen would like to trading within this range. The range is between 102.25. We just draw a line here, and the top range is about 102.8. So the trading strategy for this week is it is very likely the dollar will still fall within this range. Let's see how is next week move. Okay, why we see the dollar yen will fall this range is because we always mention in the beginning of the webinar that the dollar yen likely to follow the treasuries. We don't expect a drastic move of the treasuries, no matter it's moving higher or moving lower, right? Because the reason is the market is looking for the FOMC meeting next week, and it's seriously that it's like there's no clue at all whether Janet Yellen wanna be dovish or Janet Yellen wanna be slightly hawkish a bit. Still don't know. So if that is the scenario, market is very likely, to put the U.S. Treasury, the 10-year yield in a very narrow range. So dollar yen will follow. So two level we are looking at is one is 102.25. The other top level is 102.8. So meaning to say that if any chance that the dollar yen touch the lower range, we want to do a buy. If the dollar yen, let's say, go near to 102.8 or go even 103, then we are looking at the short for this currency pair. So this is the direction probably you can looking at. Aussie dollar, it's it seems like it breaks the new another high for the recently, and based on the 4-hour chart, right, you can see that there's a two range previously. One range is from beginning of the May to middle of the May, then the second range is from middle of May to beginning of June. It looks like the June the lower range it's already broken already, so it might be the Aussie will move back to the previous range. The previous range is between 1.9335 to 0.94, right? And it is likely that the price will stabilize in the current range, is because this week we will see a very possible another very exciting data from China that is going to support the price of Aussie, right? But this downside risk, the only downside risk for this week is the labor market report, right? So if let's say the labor market report offers no surprise into the Aussie, no surprise this week, then the price will probably continue to move between this range. And any bias I will have is I'm going to long for the Aussie in the near term. What I would do is I probably would just wait for the price to dip another 20 basis point until 1.0335. Then I would do a buy for a short term, right? So if you look at the bigger pictures, right? If you want to look at the slightly bigger picture, we go to the daily chart. You can see that this is the range that Aussie has been staying since beginning of the April. The bigger range is about 0.9230 to 0.9465. If you separate them to a small dimension, then you will see a two range, right? So now it's in an upper range. Last time it's in a lower range. Kiwi dollar. It's a very interesting pair. Okay, fundamentally, it's all fundamental driven for this week. The technical might not helps a lot. Now the level as 0.85 rebound from the 0.8420. The reason is we mentioned that the market still expect the RBNZ will hike the interest rate, right? So what I'm looking at is they probably will not really hike the interest rate in this week. So it all depends what do you think, right? Also, the good news is the Kiwi move is not so much even when data announced. So if you believe the rates were going higher, so probably before the announcement, you can do a pending buy order, right? So if let's say you think the rates will go lower, so you can put a pending sell order or even sell at spot. But don't forget to put a stop loss, right? So that's the direction for the Kiwi. It's all fundamental driven, but long term, long term, we still think the Kiwi dollar will stand for a chance to penetrate, not penetrate, but probably would near 0.88 by end of the year, right? Also, that is largely depends how the dollar move, but you know, probably if they don't cut the rate, they don't raise the rate this time, probably they will raise the rate another 2 to 3 times toward the end of the year. That should also positive for the Kiwi. Gold. Actually, I don't track the gold prices, but I guess the gold price should continue to go lower in the past week. Go high, it's still in a range, right? So the gold, you can see that it's very quiet recently, right? So why it's quiet? It's also because of number one is the direction is not very clear. Number two is people are also waiting for the FOMC meeting, right? So the FOMC meeting, let's say that Yellen gives some comment that she will still support the economy in a very dovish policy, then you will see the dollar will slightly bounce back. But if let's say we hear that the Yellen, that's the concept, is if the Yellen give any hawkish comments, like the ECB would probably, the Fed would probably start to looking at to hiking the interest rate somewhere by next year, and some strategy are being talked about already, then you will see the gold price will go lower. But in my knowledge, the best guess, in my best effort of the guessing, I still think for next meeting of the Fed, they will still probably to a very dovish view, right? So probably you will see the goal in the FOMC meeting, whereas they still have 10 days to go, but probably you will see that they have a chance to arrive at 1268 maybe, or 1270 towards that time. But now, so from now, just from the technical point of view, you can see that the hourly chart, it tells you that 1.60 offer some resistance here. Okay, so now let's go to Mario trade call. Mario trade call is to short euro dollar. The entry price is 1.3645. The stop loss is 1.3700. The TP1 is 1.36, and the TP2 is 1.3550. So that's Mario trade call for today. Now let's go to the Q&A sessions. Any question, you can just type here. Tom Lee is asking, do you think QE really helps the inflation in the US? I think QE might not really help the inflation. That's my own point of view. Number one is you can see the US inflation start to drop when the Fed announced the QE3 in 2012. So why is that so? Is QE3, it probably benefits the housing market and probably benefit the stocks market, but it's not really benefit the consumption market, right? Imagine that people are trading stocks, spend lots of money in the stocks, they're not going to spend, right? So that's a reason I think. And the other point is the QE. The problem is the money probably did not really pass to the main street very effectively. So this is the reason I see that the QE3 actually did nothing to the inflation at all in the past 2 years. So another question from Tom, that if they raise the interest rate, maybe the inflation will improve. There's no it's very hard to say, right? So the problem is we have been staying in a low rates environment for almost 5 years already. So if the rates go higher, whether it will help inflation, I see that there's no link. But the thing is the inflation problem is also not only happening in US. It's also happened in China. The China inflation also slightly lower. It's also happened in the Europe, right? So whether it's a global problem or it's only the problem in the U.S. in the Western economy, it's still very hard to say. Daniel is asking, what's your view on Euro yen and Sterling yen? Would it be synced to the major or still dollar would play a major influence this currency? Yeah, dollar of course would play a very influence currency, because we don't see in the near term, the Bank of Japan will do anything on the monetary policy side. So lots of things, Euro yen and Sterling yen probably will still follow Euro dollar and the euro and the sterling dollar, right? So for example, the trend of the dollar yen, the trend of euro yen, how it goes. So I holding my view that I still a bit more bearish on the euro dollar. So euro yen probably will also go low again. So you are right, dollar will play a major influence this week and the next week, because the FOMC will take over from here. Chan Fei is asking, do you think Chinese economy in second quarter will rebound? I think there's a quite highly chance that the second quarter economy will rebound, and that will help the Aussie as well. The reason is because of the mini stimulus, right? They have been doing lots of mini stimulus, in second quarter. So this mini stimulus is of course going to help the economy in second quarter. And you can see that the lots of leading indicators like the data, the exports data, the industrial production, the manufacturing PMI all show some rebound since April, right? So the economy is doing fine in the near term, and also thanks to the slower growth in second quarter last year. So the base is quite low. So once the base is low, it gives a higher chance for this year that they will announce a higher GDP figure. So I think that in the second quarter GDP, they probably will rise to 7.5 or even 7.6% for the for the GDP number this year. I'm still in my throat is still a bit not comfortable because I just recovered from a flu last week, right? So excuse me if there's any problem. So that's all for today's webinar in the past 1 hour plus. So it's a very good to talk to you, and I will see you again next week. So we will probably focus more next week on the policy of the FOMC meeting, and what is likelihood of the chance that the euro, the dollar will go higher and go lower, or the Fed will be hawkish or dovish. All right, so good night. See you guys again next week. Bye bye.